Welcome to Hedge Interview. This episode is part of the Manager Profiles series, which features distinguished asset managers with a unique approach in their strategy space. My guests today are Edward Chin and Thejas Nalval of Parataxis Capital Management, a multi-strategy investment firm focused on the digital asset sector. Ed is the CEO of Parataxis, and prior to co-founding the firm with Tejas, he was an investment banker at two digital asset merchant banks, Galaxy Digital and Element Group. Ed began his career at Lehman Brothers, and he spent 10 years as an investment banker executing mergers and acquisitions and financing transactions across the tech, media, and telecom sectors. Tejas is the chief investment officer of Parataxis, and prior to co-founding the firm, he was a portfolio manager at digital asset hedge fund Ledger Prime, and he was head of asset management at the Element Group. Prior to joining the digital asset space, Tejas spent 8 years at Goldman Sachs, most recently as a trader within the firm's macro trading group. Thank you both for joining me today.
Thanks, Jennifer, for having us.
Thanks for having us.
So first, tell me about Parataxis and why you decided to develop your specific investment program.
Yeah, we started Parataxis in late 2019. Coming out of the bear market of 2018, one of the things that we realized was that there was increasing interest and appetite from large, sophisticated investors across the institutional investment community looking to gain exposure to the sector. What became clear was that a lot of the vehicles and wrappers for them to express that view weren't appropriate from a risk management perspective. And so the goal when we launched in late 2019 was to provide a risk managed institutional product that would apply traditional investment and trading strategies to what we thought was still a nascent and growing a market. I would say one of the things that has evolved since then, especially between 2019 and 2021, is that the discussions with our prospective allocator base, and this includes not just high net worth and family offices who've traditionally dabbled in digital assets, but increasingly pension funds, both private and public, endowments and foundations, was that the asset class was no longer not investable. Instead of debating whether or not the asset class would be sustainable or continue to see growth and evolution, the discussions clearly changed to one of finding the appropriate type of vehicle to gain exposure to space and to figure out how to size and manage that allocation. And so what we realized with that change in tone was that asset managers that were crypto native, that understood how to find opportunities across the space, were going to be very, very important. But increasingly, individuals that had come from traditional backgrounds that think about risk management, I would say, from a traditional perspective, were going to be absolutely necessary, given the operational complexities and the plethora of idiosyncratic risks as it relates to this specific asset class. And so we had decided at that point to launch the firm and develop vehicles to allow allocators to gain that type of exposure.
It's great that you understood that because it's been really difficult or challenging, I think, for a lot of digital asset fund managers that want to attract institutional capital but struggle to because of the risk management element and just the resistance that typically comes up from institutional managers. So the fact that you developed a program that appeals to that group, into the institutional world is a real feather in your cap. And I guess what would you attribute that to? Is it how did you know how to get it right for that investor base?
I think it's a function of the backgrounds we all come from. For myself, I spent most of my early career on a trading floor at an investment bank that focuses heavily on operations and risk management. I interacted on a daily basis with the largest endowments and sovereign wealth funds in the world. So you build up an understanding over time of what really matters to the largest and most sophisticated investors over time. And I can say the same story for each of us on the team. We all come from a background where risk management mattered. We were trained to think about things the right way. So the way in which we structured our company, the way in which we structured our culture was with that mindset at the forefront.
And tell me about how you guys met. How did Parataxis come together? How did you meet?
Yeah, so I'll give you my version, and hopefully it lines up with Tejas's version as well. But so we met at the Element Group. The Element Group was an early merchant bank focused on the space, tremendous growth and market share at the time. I was on the private side, running the advisory business at the time, identifying early stage disruptive technologies across Web3 and crypto, raising capital for these businesses and oftentimes investing alongside. On the other side of the Chinese wall, facing the public markets and running the firm's asset management business, was Tejas. We were the two folks that were in the New York satellite office at the time. The headquarters was based out of Southern California. And so managing that office and teams here, although there was a separation as it related to the types of capital and investors and opportunities that we were looking at, we were more or less in contact on a daily basis and realized that we had this shared interest and perspective on the market and the opportunities that lied before us. But the market itself and the products itself had to evolve in order to meet demand from as Tejas described, a much more sophisticated investor base.
How did you decide you were ready to pull that together?
I think timing is everything, especially with this asset class. When we met, the crypto markets were experiencing its first real major bear market in 2018. Timing wasn't exactly right to launch a fund. I think like Ed said, we both come from very similar backgrounds. We both are about the same age, have young families, had similar experiences, before joining the digital asset space. So we both have more of an entrepreneur bug. We want to launch something in the space. And so I knew for me where my strengths were, where my weaknesses were, and I knew I needed to partner up with somebody who complemented my skill set, and hopefully vice versa for Ed. So we both knew we wanted to do something, but timing was everything. And really at the end of 2019, the timing was much better. And it was at that point we decided to launch the company.
Yeah, that being said, folks thought we were crazy launching into the start of the global pandemic. And so there are obviously a number of challenges, but in hindsight, it was probably the best time to be launching.
Definitely, 2018 was definitely a bear market, so that's a great time to gather your get it together and figure out what exactly, it's a good time to plan while things are not great, and then come out when the market starts expanding. So that definitely was really great timing. So tell me about your investment program and your approach. What are your focus areas within the digital asset space?
Sure. So I think even though we come from backgrounds where, for personally, I've interacted with the products and asset classes that have been very mature, we recognize that crypto digital assets, it's still a very nascent asset class. The market is inefficient. The market structure is still being architected. And therefore, in our view, there are multiple ways to earn a return, multiple ways to create value in this asset class. So that's one of our core beliefs as a company. So what that translates to within Parataxis, we look at opportunities that rely on trend following, for instance, um, both directionally, long and short, maybe relative value, pairing one name against another. We look for opportunities that may require some more fundamental bottoms up type of research into space involving tokens, involving the equity of early stage projects. We look at statistical arbitrage opportunities. Again, this market is very inefficient. As a result, there are patterns we can recognize intraday that we can capitalize on and again earn a source of return. We look at event-driven strategies. We also look at our own version of smart beta strategies. Again, it's I'd say as a in our core we're a multi-strategy type of organization, and it
Really?
stems.
I mean, that really is a multi-strategy approach.
Again, it stems from the fact that the market is inefficient. In our view, it'll remain inefficient for some time, and unlike the equities market, I think the crypto markets tend to evolve and reinvent themselves every 18 months or so. So in our view, if you just pigeonhole yourself into one source of return profile because there's an arbitrage opportunity, chances are in 18 months, 24 months, that arbitrage opportunity will cease to exist, and it'll be very difficult to exist as a fund. So in our view, the only way to really manifest and secure longevity as a fund, as a company in the space, is to really lead with this multi-strategy approach.
So that plays nicely into risk management as well, I would think.
It does. And I'd be remiss if I said there was no risk in this asset class. There is, and risk is I think a function of it being a brand new asset class. Effectively the whole financial ecosystem that we've known and interacted with for decades is being architected within blockchain and digital assets. So a lot of the strategies, a lot of the ways of looking at this world are very novel, and with that comes risk. Our job as a fund manager is to manage that risk, is to mitigate that risks where we can, and that how we do that, we tend to categorize risk based on, I guess, market risk and portfolio risk, and that's the easy part. We use some very similar risk management techniques that any traditional fund manager would use in terms of how we construct our portfolio, the level of volatility that we're comfortable with, given a certain sub strategy, how we manage our long and short exposures, our net delta positions when we hedge. But then we have to pay special attention to, I'd say, more of the operational risks that exist. This involves how we trade, where we trade, who our counterparties are, where we have exposure to. And I think we pay special attention to that part of the risk management category, only because it's very clear that who you traded with and where you had exposure to in a year like 2022, it really mattered. And I think because we paid special attention to where we traded and how we traded, we were able to survive and not expose our investors to a lot of the egregious pitfalls that some of our peers, unfortunately, had exposure to.
That's so important. Institutional investors I interview and speak with have said over and over again, it's great if you make me money, but above all, you have to preserve capital. You have to know how to do that. So it's really, and going through a tough year like 2022, or any challenging period is just a feather in your cap that shows that you weathered the storm. You know how to get through, because there's been so much attrition in your space, right? And you're still standing, so that's extremely important. And given the the breadth of your the tools and the tactics that you apply, tell me about your team and your organization. How big? How many people are involved in the Parataxis operation?
Yeah, given the multi-strat approach, it does require a combination of different skill sets. I think the overarching requirements, though, are what we described up front, is that the folks have to be crypto native. So it's not just looking at the price of a digital asset and trading that, but have an understanding of the fundamental drivers. Because at the end of the day, price should at some point reflect fundamentals, whether that's growth or adoption, um, or, or 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 some other metric. And then the second requirement is the traditional background, so that we are all on the same page as it relates to thinking about building an institutional product and thinking about risk the right way. And so we have a team of 7 today: 4 investment professionals, 2 non-investment professionals, and we do have a separate Bitcoin mining business. And so we have a Bitcoin mining operations lead there. That business is interesting because it allows us to delve into uh, the other parts of the ecosystem, whether it relates to the infrastructure stack or understanding how mining pools operate, um, the effect of hash rates, difficulty, and what that would mean for price. And frankly, it does impact how we think about our strategies at times as well. And so, outside of Tejas and myself, we have a third partner, Julian Grob, also from a traditional background, much more tech banking and private equity focus. He spent time at KKR and Lazard before joining us. And I would say we've used 2022 to not only survive, but to map out the next stage of our growth. We've been able to expand and hire on our team. We've brought on a quant researcher um, who spent a large part of his time at various quant hedge funds, including AQR, who's building out a lot of the quant systematic strategies for us. And then, given the non-investment related workload as it relates to managing an asset management business, controller, head of ops, and somebody that's dedicated to the IR function. And so that allows us to have a team that can be pretty much dedicated to managing our LP's assets the right way, and to find new and interesting opportunities, but also kind of manage and run all the other parts of managing a business in this space.
So speaking of 2022, what are all asset managers evolve? Everybody has lessons learned, no matter what strategy space you're in. So what would you say are some of the key lessons learned that you're taking with you into, or hurdles you've overcome, however you want to frame it, as we move further into this year?
I can kick that off with a few. I think one thing one thing we knew going into a year like 2022 that it was very demonstrated it was valuable was just communicating with investors and communicating with stakeholders, especially when there is when there are events that are occurring in the marketplace and information is getting disseminated in real time over social media, over Twitter. Um, you know, it's clear that all of our investors are seeing certain headlines, and how they interpret that is important, and providing some context is important. So we did a lot of communication last year, especially last summer, especially during the the debacle of FTX in November, and it was largely it was largely just to set investors at ease. And there were weeks at a time it seemed like we were just putting out a brand new investor email just to tell everybody it was, we had exposure to XYZ counterparty, this is how we're thinking about the world. And just, in a normal market environment, that type of communication may be overkill at times, but especially in a world like we lived in last year, I think it allowed us to really demonstrate how we thought about the world when things are bad. But it also, I think it gave a lot of our largest investors just more confidence in us. And so
Yep. I'd only add that as it relates to the markets, you can't be an ideologue in this space. And so the notion that you should sell everything and just go into digital assets because it's going to take over the world, it's not the right way to be thinking about the space. And unfortunately, a lot of stakeholders in this ecosystem, their decision making is binary. I'd say the thing that we took away from 2022 specifically is that macro matters, and the macro environment, macro volatility matters. And so I feel like 2022 was a year where high yield was down 15, 20, 25% at one point. Equities obviously had a drawdown as well. And we're starting to see cracks in commercial real estate and other parts of the credit system. That's a function of the macro environment. It obviously had an impact on digital assets as well. And so although we always have a view towards the fundamental drivers and the crypto native narratives that we think will lead to growth and adoption and allow these persistent arbitrage trading opportunities to exist, we have to take a step back and understand the asset class in light of the wider macro picture as well.
I think that's really important for every strategy. You just kind of can't ignore the big picture of what's going on. I mean, even your investors, they want to know what you're thinking during those periods and understand what your approach is. So it's definitely important. And Thejas, your background, being a part of the Goldman Sachs macro trading group, particularly, obviously that experience lends itself to this, to what you're doing now and paying attention to all of those things, I would think.
No, absolutely. And just to piggyback on what Ed said, when we entered the crypto space in 2017, there really weren't any institutional investors in the space at large. There were a few funds, but the space was largely invested by high net worth individuals, maybe some family offices. There were no pension funds. There were no corporates buying Bitcoin or buying really any digital asset. And even the players that were the market participants were largely crypto native. So this is the first cycle where you saw a bit of a transition of traditional investors coming into the space. Pretty meaningfully. You saw traditional market participants, market makers, brokers actually entering the digital asset space, either largely through the futures market, but which does have a correlated effect on spot volumes. And so, the macro having an impact on the digital asset space, it shouldn't have come as a shock to anyone. I think it is, especially when you have an overlap in market participants that now view digital assets as part of a multi-asset portfolio. So there's going to be some causality between asset classes, and it's something that we, especially when we see macro headlines, we always try to understand what the impact could be short term and long term, for our asset class and also within our funds.
And how have things changed in terms of institutional money participation in the digital asset space since last year into this year? What are you witnessing as far as their interest in the digital asset space.
Yeah, I think going back 2 years, a number of institutional allocators had identified this asset class as one that they need exposure to. And so I think folks have moved beyond will Bitcoin disappear to this is here to stay, but we need to be able to manage volatility and get the right type of exposure. And so, um, 2022, I felt like was going to be one of the greatest fundraising years, at least for our fund. But all that was kind of put on pause when FTX happened. I think
Right.
FTX was one of the largest exchanges in the world. If you look at their equity cap table, they had a number of prominent individuals that had vetted that opportunity and still weren't able to kind of identify certain risks. And so for a lot of institutional allocators that had already vetted the sector, figured out the type of exposure that they wanted, they had to go pencils down. I think that's changing right now. We're seeing a thaw, and conversations have gone back towards identifying, the survivors from last year, and trying to sift through the best way to get exposure to an ecosystem that has over 20,000 cryptocurrencies available out there. And so that requires working with managers that breathe this day in and day out. But what we're realizing, one thing that has changed is a move away from, I think, just getting passive exposure given the volatility, and more towards um, managed strategies, whether it be low vol, high sharp type of strategy, something that may have directional or quantitative components to it. And so that's a bit exciting because we get to help allocators figure out and create products that are bespoke to the specific type of exposure that they're looking for. And to the extent that we can apply traditional investment strategies and risk management practices, to provide that exposure, uh, we think it's a great opportunity on both sides.
And what are you focused on right now in terms of the macro environment?
So, one of the views that we had at the start of the year, or at the end of last year, more closely, was that there would be a meaningful amount of supply pressure in the digital asset market, both from folks likely it's more of a year-end dynamic where you see some rebalancing occur across the space, both within crypto native funds and also within traditional funds that may have some crypto exposure. Our view was that we would see a sharp mean reversion to start the year, just given any time there is a disproportionate amount of buying or selling. Usually there is a nice reversion to the mean, especially with something as inefficient as crypto is. And we've seen that evidenced already in Q1. You know, there were most of the market was up anywhere from 50 to sometimes even 150% for in Q1 itself. And that's just purely a market structural dynamic that existed. Our view now is that a lot of the forced selling that took place is behind us. Forced selling from either leverage that existed in the ecosystem, exposure to the BlockFis, the Celsiuses, the FTXs of the world, and so the market's behaving a bit more rational today. We are, though, paying attention to what's happening, I'd say less on the macro side, but more on a regulatory side, both here in the US and globally. It's something that we're paying attention to in real time, because obviously a lot of that has an effect on, I would say, less about prices, but more of an effect on perceived behaviors of different participants in the ecosystem. So I mean, and as it relates back to the macro space, whether we're not a macro fund, but we are paying attention to what the Fed is doing and what we think the Fed will, where they'll land at the end of the year, and how that's going to impact traditional risk assets, and what impact that's going to naturally have on Bitcoin and really the rest of the ecosystem. There's a bit of a cycle. We do think, it is our view that if the Fed does pivot eventually, if there is a shift in language, that will likely trigger capital to flow back into what traditionally has had the highest beta, and that's been digital assets, it's been Bitcoin, it's been Ethereum, and so we should see a little bit of a sharp uptick right off of the back of any sort of language that would assign a pivot. It's not going to happen anytime soon, but likely at some point, either later this year or early next year, is where we see a bit of an inflection point. I think it lines up very nicely with the halving schedule that Bitcoin has. Every 4 years, Bitcoin's the amount of Bitcoin mined in a block, it's cut in half, and historically that has always been the start of a secular bull run for crypto. So a lot of the forces are lining up for the end of this year and early next year to be a much more constructive market environment for this asset.
And hopefully the worst is behind us as far as interest rate hikes, because with a bunch all in the fall of last year had a really strong impact on the markets, and everything contracted. And I feel like that, my observation is that the Fed looks back and is like, ooh, I guess we need to not ease, but approach this a little more gently so that the markets don't get crushed like they did last fall, or the whole economy. I don't mean just the capital markets, but it had such a harsh effect that hopefully the worst is behind us, and even future hikes will be staggered.
Yeah. I think the other thing that's really important as it relates to macros is it's always evolving, because the narratives surrounding the macro picture, and I would say separate asset classes, is always evolving. If you think about the narrative surrounding digital assets, and specifically Bitcoin last year, it revolved around BTC being somewhat like gold and serving as an inflation hedge, and that narrative was clearly invalidated. And I think part of the resurgence and interest in the asset class is BTC as a source of having a hedge against monetary debasement, and so that's going to definitely impact the macro. We have a macro overlay, and as Tejas described, always have a view towards what the Fed may be doing, what is the money supply doing, what do interest rates, what does the outlook look like for rates, but that's an overlay. At the end of the day, we do still have a bottoms up approach, and that's a crypto native part of this asset class. It's not just the fund flows in the market microstructure. Those are really important for a number of our stat ARB strategies and trend following and relative value strategies. But there's just tremendous growth that still exists in the space, and disruption. And so by taking a bottoms up approach, it does allow us to kind of sift through the landscape of as I described, 20,000 digital assets, to find the best ways to kind of gain that type of exposure once growth resumes.
And so lastly, what developments are you looking forward to in terms of, the growth at Parataxis, or macro developments, or things on the horizon that you're positively looking forward to?
So we're excited because we have a multi-strat approach, and what that means is that, as Tejas described, depending upon what the market is doing or what the macro environment looks like, we can overweight or underweight different types of exposures in order to kind of get a composite risk-adjusted return profile, attractive risk-adjusted return profile. I think what's exciting for us is that there are a lot of allocators that are doing a lot of work on the space. And the way that we know that is that instead of just digging into the sector at a high level. They're trying to understand specifically how some of these ARBs work and different ways to gain exposure that replicate strategies in TradFi, but have higher returns oftentimes, just given the market is more nascent, it is more inefficient. And so that's a bit exciting for us to explore because we can parcel out specific exposures and provide that through different types of structures that are most relevant and help for prospective allocators. The one other thing I would say is the market does feel like 2019, um, almost 4 years ago, going into a halving year. Back then it was in 2020. Obviously, we're blindsided by the pandemic, but 2018 was one of the worst bear markets on record for the sector. And had anybody taken the time to look underneath the hood, they would have seen that there was still tremendous technological innovation, adoption taking place. And 2019 felt like the year of consolidation before growth resumed. Uh, our view is that to the extent that that is a similar cycle that we're in, hopefully 2024 we'll have a much more accommodative macro backdrop because it's clear that the innovators in the space are building, and at some point that building and adoption should be reflected in the price of digital assets.
And it's great that allocators as well are expanding their understanding of the digital asset space, and they're
Yeah.
more open-minded going forward. I think that also helps because, again, weathering this period and seeing that digital assets aren't just going to go away because of a difficult period probably helps bolster the whole digital asset sector as far as being a real meaningful place to consider allocating, given how that sector behaves, and that it's here to stay, and that there's so much opportunity yet to discover. For it's just definitely under allocated too,
And
and
just
probably will be for a while.
Yeah, and just to add to that, Jennifer, I think a few years ago when allocators were researching the space, usually the trend was the dynamic was there was usually a junior person on the team that understood the space, and they were given ownership of, hey, just figure out if this is something we should pay attention to. And this was 4 or 5 years ago. Those junior people have now been promoted, and usually now what we're seeing is that they're in a decision maker's seat. And when we speak to allocators, the conversation isn't, what is Bitcoin, what is blockchain. It is very crypto native. Is we're getting deep into the weeds, and whether it be DeFi, whether it be NFTs, whether it be infrastructure plays, and these are very, very these are very interesting conversations for us too, because we're speaking intelligently about areas of the ecosystem that sometimes goes underserved in traditional media. So it's clear that allocators have a very strong thesis on the space. It just goes back to timing. I think there will be a timing component to where the opportunity cost of not being involved is actually greater than just sitting on the sidelines. And so I think I think we're excited for when that timing element does shift. And I think for us as a company too, and when we started Parataxis, it was just Ed and myself, and it was largely our thinking was, let's build this. It was a very Field of Dreams-esque, let's build it, they will come. Whereas now we have a very strong team. We have a very capable team. There are folks on our team that are smarter than Ed and I and myself. That
Most of them are.
Most of them are. Yeah, and that's we have the right people, and that's almost a force multiplier as it relates to just being a company in this space. And so now when we do transition to that moment where allocators start entering a space in a meaningful way, they will come and we can build it. We can build whatever product or vehicle they'd like, and we couldn't do that 3 years ago, and it's because we have the right team. So I'm really excited for that.
Fantastic. Well, that's really exciting, and it's great that those conversations have evolved, and the market has the digital asset space has evolved. So it's really, even though the environment might still be a little challenging, the fact that so many other things have evolved, just speaks to the opportunity in the sector. So thank you both so much for participating today and being here to tell us about Parataxis. And for folks that want more information about Parataxis Capital, you can visit their website at parataxis.io. And again, thanks so much, guys. It's been great having you here.
Great. Thanks, Jessica.
Thanks, Jennifer.
All right.